The stock market crashed here. The latest tariff announcement has sent stocks plunging. Just look at the S&P 500 heat map. It's a sea of red. Big names are taking massive hits. Apple is down 13%, Nvidia 14%, Meta 12%, Amazon nearly 10%, and Bank of America dropped 17%. So what do investors do now? I have seen this playbook before, but that doesn't make it any less nerve-wracking, especially for those nearing retirement. Today's video is going to be a bit different. I'm sharing my thoughts on the current market condition. Before we jump in, please do me a favor, click the like button, subscribe to the channel, and let's dive in. Hey everyone, welcome to the Stock Lens. Quick reminder, I am not a financial advisor, so don't take this as financial advice. As of this video, the S&P 500 is down roughly 9% just this week. Why? We had what some are calling Liberation Day, but it felt more like Inflation Day. The US just announced steep reciprocal tariffs on over 60 countries, which sent markets into a tailspin. This is the worst market drop we have seen since 2020. Trade wars don't really have winners, and the ripple effect could lead to a global recession. JP Morgan just raised their recession odds from 40% to 60%. UBS and RBC both slashed their S&P 500 targets for the end of 2025. UBS. Now their projects 5,800 and RBC even lower at 5,550. The key thing to remember about tariffs, they often ends up as a tax on us, the consumers. The goal is to reduce reliance on imports and shift buying power back to US manufacturing. But that can't happen overnight building. Infrastructure takes time. Here is a quick breakdown of the new tariff rates. China 34% added to their existing 20%. Vietnam 46%. Taiwan 32%, Japan 24%, India 26%, EU 20%. These are huge increases and could be temporarily, hopefully, a negotiation tactic more than long-term policy. So, where does the Federal Reserve fit into this? The Fed's two main jobs are to keep employment strong and inflation in check. Unemployment is currently at 4.2%, which they are comfortable with, but these tariffs may fuel inflation further, potentially forcing the Fed to lower interest rate to compensate. I believe this could be a strategic move by the administration to take a short-term market hit in exchange for lower rates, which would help refinance America's massive debt. At the start of the year, markets expected only one rate cut in 2025. Now, we are looking at 4, maybe even 5, depending on who you ask. Now, let's look at the S&P 500 chart. It's currently around 5,100, the align with the August 5, 2024 lows. If that level doesn't hold, we are likely headed to 4,930, then 4,700, and possibly down to 4,500 equivalent to $450 on SPY. That would mean another 11% drop, firmly pushing us into bear market territory. So what should you do right now? Don't panic. Emotional investing rarely ends well. Review your portfolio. Are you too concentrated in one sector like tech? Maybe it's time for minor adjustment, not full overhaul. Just tweaks. I always say time in the market beats timing the market. Think back to March 2020. We saw 2 months of selling, then a huge V-shaped recovery. If you sold at the bottom, you likely missed the rebound. Check out this stat from 2004 to 2023. If you stayed invested in the S&P 500, your returns averaged nearly 10% a year. Miss just the 10 best days, the returns gets cut in half. Miss the 20 best days, you are down to just 2.8%. Trying to time the market is risky. That said, it doesn't mean you go out and buy everything just because price dropped. Focus on quality and valuation. For example, tech investors have been hit hard. Even if they had strong gains over the past few years, a lot has been wiped out. So where to look? Defensive sectors, healthcare, consumer staples. Look at stocks like Walmart, just down 2.5% this week. Costco, down less than 1%. Procter & Gamble, down 2.5%. Coca-Cola, down only 1.5%. These types of companies tend to weather storms better. If you have got a 10+ year time horizon, this is the opportunity to check out. CHD ETF, currently around $25, great for long-term exposure. Amazon, trading at a EV/EBITDA of 60%, lowest in over a decade. Other strong names, Chevron, J&J, Merck, ConocoPhillips, PepsiCo. Again, this may not be the bottom. Stocks can still fall, but this is when you focus on value and resilience. This video was a bit of different style, but I thought it was important to share my thoughts given the current situation. Let me know in the comments if you want more market updates like this. Don't forget to like, subscribe, and I'll see you in the next video. Take care.